Hello everybody, this is Ron Wheeler from eSignal Learning, and in today's blog posting I want to talk a little bit about options trading. In today's mentoring, this is August 22nd, in today's afternoon mentoring one of our clients pointed out a possible stochastic sell. On this chart, it's Ryder on a daily chart, and we talked a little bit about the options element of this trade, what to do if you're going to do the options component of this instead of just shorting the stock. One of the biggest questions I always seem to get when it comes down to an options trade is, when it comes time to buy the option contract. Now, we're going to keep it simple for this trade. We're not going to do anything with a spread or anything like that. We're simply going to buy some puts. What we expect this market to sell off and possibly make a new low. We'll talk about that in a second with the mob and the entry and things like that. But I get this question a lot as far as, what strike price do you buy? Do you want to go in the money? Do you want to go out of the money? What's the optimal options contract to purchase in something like this? So I'm going to walk through it and kind of give you my take on it. Now, my take isn't the only take out there. This is just the way that I manage my trades and what I look for when I decide what options contract to buy. So I'll walk through the trade real quick with you. This is Ryder again on a daily chart. The trading strategy we're looking at here is a false bar stochastic sell. We've got downtrend in place all through April, May, June, and then into July, and then through mid-July. The stochastic is above 75, indicating a sell signal. Now, the only thing I need to verify is that this market did not make more than a 62% retracement. The stochastic trade, if you remember, is based off of the concepts of an Elliott wave 3 and 4. Not necessarily an Elliott wave 3 and 4, but it's based off that premise. Whereas when there's a false bar, that's a trend. When the stochastic goes above 75, it's a retracement. Just a couple quick things about that trade while I'm referring to it as far as the Elliott goes. The stochastic trade is typically a lot easier to identify than an Elliott, mainly because in order for the market to be in a wave 3 and a wave 4, you have to have a perfect wave 1 and 2. So for this to be a type 1 trade, this would have to be a wave 4. In order to get a wave 4, wave 3's got to be in the proper ratio, wave 1 and 2 have to be in the proper ratio. You have to have a lot of moving parts. So the type 1 trade's a little bit more, you're not going to see as many of them, is what I'm trying to say. The false bar stochastic is simple. It's based on the concept of a trend in the market. It doesn't have to be a perfect 1, 2, 3. It's just got to be a trend, followed by a simple retracement. So you're going to see a lot more stochastic opportunities and less type 1s because the type 1's a little more strict in the wave count, the wave makeup, and architecture. Whereas, again, the stochastic is just simply trend, retracement, you're done. So I wanted to point that out before I got too carried away. Now, another thing I'll talk about real quick is you notice there's some blue bars in this retracement. And a lot of people would look at that and say, well, Ron, aren't you concerned about all those blue bars? No, I'm not, because as long as the false bar stochastic is still in play here, and the false bar stochastic is going to be in play as a selling signal unless one of two things happens or both happens. First thing is, we would get a black bar appearing at the top of the stochastic indicating this market's going into an uptrend. We don't have that here. We have a downtrend in progress, followed by a sell signal. The second thing I would look for is a failure of the 62% level. This goes right into the Elliott logic. A wave 4 typically does not retrace more than 62%, or the trend reverses. This is we're going to treat the same way. You've got a nice 62% level still being held. I'll draw it in from this primary pivot back here in March, and here is my 62% level on this market. We're only right now at 42.73. Our 62% level is right up here at about 47.13 or so. So as long as the market doesn't get past 47.13, the stochastic tells me I still have a higher chance of going and making a new low than I do of going up and reversing the trend. So until that 62% level is violated, I really don't pay attention to the XTL. That's just one of my own personal rules. And I talked about that a little bit in my last blog posting in July. Now, since this is a stochastic sell, I validated, made a good case for it. I'm going to take a mob from my primary pivot low back here on July 12th, I'm going to left click. Now, the mob is pretty important when you're doing these options trade because the mob gives you two things. It gives you time and price. If this market can sell off and make a new low, I'm expecting it to get down to this mob at about $27. Now, I'm using the upper edge of the mob as my target, and if you really want to get particular, that's about $27.31. I'm just going to round up to 27. I'm expecting this to drop from $41 down to about 27. Now, if you look over here, this little hash mark, this is the timing. October 15th is where we're estimating that this market will make a new low. Now, that's good for options because we got to pick expiration. Now, what my recommendation is when you're picking your options expiration, look at the hash mark of the mob. It says October 15th. We can't buy the October contract because that's when it expires. It expires in October. Once October 1st hits, what happens is the time decay or the theta of the options contract starts to accelerate as we get closer and closer to expiration. If this thing comes down and finally hits the mob, let's say on the second week of October, we're going to be losing a considerable amount of our options value to time decay. So if you have a projection where the market's going to hit in October, I would recommend you go out 1 month to November. Or you go out to the next trading month. If there's no November options, maybe you got to go to December. But always give it 1 month or one contract past what your target is. That way the time decay is not going to hurt you. So we've got that already. We know we're going to have to choose November at the earliest or whatever contract option is next. So we know November. Now we got to start deciding what strike price. Now, strike prices are going to, be different based on whether the option is in the money or out of the money. And if you're not familiar with the term of in the money, out of the money, when I buy a stock option, I'm going to buy a put on Ryder because I anticipate the market going down. If I buy a put at, let's say, $48, okay, here's a price of $48 on my chart. I have the right to sell, if I buy one $48 put on Ryder, I have the right up to expiration to sell Ryder at $48. Well, Ryder is already at $41. So that $48 has profit. It's got value built into it. It's in the money. If you go below, if let's say I look at a $35 or a $36 option contract, well, Ryder right now is $41. If I have the option to sell Ryder at $36 and the market's at $42, that option has no intrinsic value. I'm basically out of the money. What I like to do when I take my options contracts, I like to go as close to in the money as possible. I try to balance in the money, out of the money, and I try to get my entry price of the stock right close to my premium price for the option. Here are the strike price for the option. Give you an example. To enter into this trade, I'm going to take a regression trend channel from the primary pivot low to the retracement high. Now you can see today the market closed below and actually broke the regression trend channel. That's at a price of $41.19. What I would try to do if I'm going to trigger this trade right at the break, I would try to find an option contract close to $41 a share. So I'm going to click on New. I'm going to click on Option Chain. And let's put Ryder in here. And let's go out to October's too soon. We got to go to November. Now, on the right-hand side are all of my puts. All right, so the price on Ryder is $41 a share. Anything that's green on your option is in the money. The bronze color, the brown color is out of the money, and these are way out of the money. So if the price is $41, $40 is out of the money because we haven't gotten to that yet. $42.50 is in the money. The market's already at $41.19. We're going to have the right to sell at $42.50. We're already in the money by $1.30 or so. Okay? Now, as you go down in price, $45, $47.50, $50, these are, further and further in the money. As we go up, $40, $37.50, $35, $32.50, these are further out of the money. Now take a look at the last price. The one that is just in the money is a $4.90 cost. If I go 1 unit out of the money at $40, it becomes a $2 option contract. If I go another unit out, I'm paying $1.15. If I go one more unit to $35, I'm only paying 50 cents for the option premium. I'm basically paying an eighth of what I could buy, actually a tenth of what I can buy an in-the-money option for. Now, here's what you have to consider. First and foremost, if this market hits the mob, you're making money either way. That's not the consideration. Okay? What you've got to look for when you're pricing an option out, and this is the way I do it, what if the market does not get to the mob? As most of you know that have seen me trade and have seen me do the mentoring, I like to think of myself as kind of an aggressive trader. I like to get into my positions as quick as possible, and then I like to start taking profits as soon as I can. So let's go to Ryder. Let's go back to the chart, and I'll keep this kind of in the background. Let's go back to our chart, and let's start thinking about if this market does sell off, it broke the regression trend channel today, where can this market start to hurt me? Where are the support levels between our entry and our mob? Now, one of the things that I like to do, I like to use an ellipse. I'm going to use a normal ellipse. I'm going to draw that from the primary pivot low. So I'm going to left click an ellipse from that primary pivot low up to the retracement high. Now, one of the things I like to use this for is kind of my fail-safe level. I've noticed that a lot of times when a type 1 trade or a false bar stochastic trade fails, these ellipses oftentimes will catch it before the reversal back up. So what I've got to take into consideration here is I've got support at $37.73. Now, I'm just going to round it up to make it a little bit easier. $37.73 is $38. When it comes time to picking the options contract, my goal is to balance options pricing. I'm going to try to get into an option as cheap as I can, but I also want to make money on this position if it only goes down to that ellipse level at $38 and reverses. Now, like I said, if this option or if this market gets down to $27, it doesn't matter what option contract you buy, you're going to make some money. The key is, what if it only goes to 38 and then reverses? I want to make sure I'm still making a little bit of money. Now, what I'm going to do, I'm going to bring into the picture a risk graph. Now, a risk graph you'll have to probably get from a broker software or another piece of software because eSignal doesn't support those. I'm using a risk graph from Option Dynamics. Now, what I'm going to do is I'm going to show you how the different options prices price out if the market only gets to $28 a share. So I'm going to put a position in here. I'm going to buy one November $42.50 put. So I'll apply that. Now, this is my risk graph on the bottom. This blue line signifies potential profits as the market goes in my direction. Okay, so let me spread the lines out here so I can get a little bit closer and show you what the profits would be if the market only goes down to, we said $38. Okay, let me go back to my chart and just verify that. Yep, $38. Now what we're doing is we're using the 42.50 put for this thing. The 42.50 put is already in the money. So let's go back to our risk graph. Now, if this market goes to $38, that's all the way out here. Okay, that's $38. If it goes to $38, my option contract that I buy is going to be worth about $202. So if I only go to 38 and I take profits on one of my options contracts, I'm going to lock in $200 worth of profit when I buy an in-the-money put. Now, what I typically do in a trade like this is, let's say I buy 7 puts. When the market hits that first profit objective by the ellipse, I'll usually take maybe 2 contracts off. So I would lock in $400 in profit in this position and exit two of my puts. Then I move my stop back to what I paid for the option price. Okay? If I bought these options for, let's say the last price, let me take a look here. My screen got a little out of focus there. The last price on that option was, let's see, $3.70, I believe it was. If I pay $3.70 for that option, and I get out of it when the market hits 28, and I make $200 on my option, I'm going to put a stop on my trade for $3.70. That way, if the market goes against me, I get out of the rest of my position at break even, and I'm still sitting on that $200 contract, that $200 profit. Or if I did 2 contracts, I'd be sitting on a $400 profit. Now, as you start going out of the money, that's the $42.50. Now let's go out of the money at $40. Now the $40 option's a lot cheaper. When the market gets to $38, let's spread that out a little bit. Here's 38. When the market gets to 38, my out of the money is down to about 150. You see what happens? As the market gets to that price, I'm making less and less money. Now, the upside of this is instead of paying $3.90 for the option, I'm only paying $2. So I'm saving 50% essentially, but I can still make $100 if the market gets to $38 where that first ellipse is sitting in there. Let's go out one more. I went out to 40. Let's go out to $37.50. Now $37.50, if the market gets to $38, my option contract will be worth about $90. So I'm still able to take a little bit of profits off the table. As I go out even farther, let's go to $35. Now if the market gets to 38, I'm only making about $40. You see, what you have to do, you have to balance what you could possibly make at the first profit target to what the option is going to cost you. Now, in a situation like this, I don't think you have to buy the $5 in the money option. You can actually go out. I'm actually going to be comfortable going out probably not to the 35. The $37.50 is a nice compromise. It's out of the money. Okay? I'm only going to pay about $1.15 for it or so. That was the last price. And if the market gets to 38, I'm still in there where I can make, $115 or around $100. So if I get out of 2 contracts there, I make $200. Now the nice thing is okay, I could have made $400 if I bought the in the money, but look at your total risk out. You're buying a contract for $4.90. That's $490. If I take 7 contracts, I'm basically buying a $3,500 trade. If I do 7 contracts with $1, I only risk $700. Now, the spread is the same. Okay, if this market goes to $27, my option contract's gonna be worth $880. Sure, if I buy the 42.50s and the market goes to $27, which we thought it would, my options contract would be worth $1,300. But remember, you're risking a lot more money by buying the money the option contract that is in the money. Now, sometimes when you look at these risk graphs, you're going to find that you have to buy it right in the money by a unit because your profit target's out there, and by the time you get to your profit target, when you start going out of the money and buying the cheaper option, you're not going to have any profits to take if the market holds that ellipse and reverses. You want to make sure that by the time that market hits the first profit target, you've got some money in that trade where you can take some profits, move your stop, and it gives it a little bit more room to let the trade play out. Okay? So in this position right here, I'm comfortable with the 37.50 puts. Now, what I tried to do today before the mentoring shift ended, I looked at this trade probably about 3:45 p.m. And as I was explaining it to the class, the market ticked at 4:02, and as soon as I tried to put my order in to buy the 37.50 puts, I got a little message that says, please note, markets for this security are open at 9:30 and close at 4. I tried to put an order in at like 4:02 and I missed the trade. So what I'm going to do tomorrow is, if this market breaks today's low was $40.92. So if this thing breaks today's low, $40.92, I'm going to go ahead and I'm going to buy those 37.50 puts. They're only about $1.15 a piece right now. If it goes, maybe it might be a little bit more expensive tomorrow, but that's the option contract that I'm going to go with. They're cheap, they're a little bit out of the money, but even if the market only gets to 38, it gives me plenty of distance there to make a little bit of profits on the trade. Okay, I'll update you guys on this trade, and I'll try to post a little message tomorrow morning if the trade actually does trigger, and then I'll keep you guys updated as far as the profit taking goes on the position. So until then, we'll see you guys next time, and thanks for listening.